PKD almost looks like that other stock we traded, doesn't it? I'm just watching everyone's orders, watching the times and sales as well. Just seeing if we're going to get volume in on it, see if some bids are going to start stacking up. So I'm getting in. I see bids at 568. I can't let it drop below 560. Alright, I'm out. Lost 50 bucks. If it comes back up, I'll get back in it because, like I said, I think this one does have a ton of potential. The reason I'm glued to this stock is on a low flow reverse split like this, just like SCON, it gets halted fast. When volume comes in, it's going to rush in. I want to take you back to SCON though. This was my big winner earlier in the week, and I traded it very similar. Now I'm on a 5-minute time frame, but this was very, very similar to PKD, as in we did a reverse split from $1 up to like $9. So we did a 1 to 9 or 1 to 10 reverse split. SCON sold off at the start of the day, and then we saw it rounding up, U-shaping, break of the VWAP, and then got halted. It was on very light volume when it did that, but it was the same type of play. It had a reverse split. It was now a lower float, so a lower float, higher demand, bigger rip. SCON was very similar, as in it had a reverse split, and a reverse split causes a company's float to become a lot smaller. So now these shares, the more that are bought up, the bigger the rip is going to be because there's far fewer shares, less supply, more demand. That was the only reason I was interested in PKD. So that was about, I had 600 shares and I lost about 9 cents on that. My reward would have at least been 3 or 4 or 5 times that. Just like on SCON, I only had 300 shares, but I made over $500. And I learned my lesson from that time, because this time I sized into this play. So I bought some more shares of it as it was rounding up, and it didn't work out. I minimized my risk and I cut out, and now the bids are at 506, and I cut out near $6. Cut out around $6. And now the bids are at 506. So this is a lesson on minimizing your risk, predefining your risk, and sticking with your trading plan. Okay guys, I'm going to throw this in there for free. What a lot of amateurs do sometimes, which in turn blows up their account, is during a trade, mid-trade, they deviate from their original plan. They change their risk parameters. So for instance, if I had gotten in on this stock, let's say around the support level, around 560, they would have said, okay, well, if it goes down to 550, I'll get out. But 550 should hold. So it comes down to 550, 550 cracks, it doesn't hold. And then they still are saying, well, it'll probably U-shape and come back around up to 550. We'll just give it more time. And they completely change their risk parameters as the stock just drops. And sometimes that's going to work out, but it's the wrong lesson to learn. If you learn your lesson doing that, you're doomed for failure. You have to accept your risk parameters. You have to predefine your risk before you ever enter a trade. And then if it cracks that level, get out. Because at that point, you're just holding and hoping. And hoping is not a strategy in the market. Hoping will not make you a lot of money. What will make you a lot of money is predefining your risk, having a 2 or 3 or 4 to 1 risk-reward ratio. The interesting thing about stock trading is that your risk parameters, your risk-reward only has to be, I mean, it can be a 1 to 2, as in you can only win 33 or 4% of the time and still come out profitable if your winners are 2 times the size of your losses. It's not entirely about being correct every single time. It's more about how are you managing your risk. And so today, that's the lesson. It's going to be managing risk. How to manage risk. How to manage risk on a Friday. How to manage risk on any trade, really. Thanks for watching, traders. Go ahead and hit that subscribe button. I'm on a journey to get my account to 25K. And I want you to be able to learn from my videos for when you might open up an account, or if you're trying to grow yours as well, we can grow it together. Thanks, guys.